life insurance. The popularity of life insurance is due in large part to the favorable income tax treatment it receives under the U.S. tax code. This lesson looks at the taxation of individual life insurance. Tax treatment of premium payments. Life insurance premiums are generally not tax deductible, whether the insurance is used for personal or business purposes. There are a couple notable exceptions. When the insured pays the premium of a life insurance policy he or she donated to a charitable organization, the premium is a tax-deductible charitable contribution. When the ex-spouse pays for life insurance as part of a divorce decree, the premiums are tax-deductible as alimony. Income taxation of life insurance death benefits. Life insurance death benefit proceeds are generally income tax-free. A possible exception to this is the transfer for value rule, discussed below. This income tax exclusion makes life insurance an attractive financial and estate planning tool. The interest earned on death benefit settlement options involving proceeds left with the insurer, for example, period certain only option, are subject to income taxation in the year earned, whether paid out then or not. The death benefit principal retains its income tax-free status, regardless of when it is paid out. Transfer for value rule. While life insurance death benefits generally avoid income taxation, there is a notable exception. It is called the transfer for value rule. With a few key exceptions, if a life insurance policy is transferred for value, i.e., sold, to another party, a portion of the death benefit proceeds is taxable to the beneficiary. The portion of the death benefit subject to taxation is the policy's gain, calculated as follows. Death benefit. Sum of new owner's purchase price and premiums paid equals policy gain, taxable. Example. Leo owns a $100,000 policy on his life. He sells the policy to his younger brother, Bruno, for $50,000. Bruno names himself as beneficiary. Bruno is now responsible for paying the policy's annual $1,000 premium. 4 years after the sale, Leo dies, and Bruno receives the policy's $100,000 death benefit. Bruno's taxable gain in the policy is $46,000, based on the following calculation. Please pause the audio and review the table. Exceptions to the transfer for value rule. Several types of transfers do not fall into the transfer for value rule category. If a transfer is made in any of the following situations, then the death benefit is not taxable. A policy is sold by the current owner to the insured person. A policy is sold to a business partner, or the partnership, of the current owner. A policy is sold to a corporation in which the current owner is an officer or shareholder. Estate taxation of life insurance death benefits. The death benefit of a life insurance policy owned by the insured at death is included in the insured's estate. This includes policies that were transferred to a third party by the insured within 3 years prior to death, in which case, the transfer is subject to the bring-back rule. Whether there is a tax consequence to having a policy included in one's estate depends on the total value of the decedent's estate. If the decedent's estate is valued greater than the current estate tax exclusion amount, the policy's death benefit is subject to estate taxation. For this reason, affluent life insurance applicants are generally advised to make the policy owner someone other than the insured. If the estate value is less than the exclusion amount, as it is with most Americans, the estate is not subject to taxation, and therefore, neither is the life insurance policy. Income taxation of life insurance cash values. Life insurance cash values grow tax-deferred. If paid out as part of the death benefit, they effectively become income tax-free. However, if the cash value is distributed before the insured's death, the picture gets more complicated. The question of taxability then hinges on whether the distribution is due to a policy loan or a cash value withdrawal, i.e., full or partial surrender. Policy loans. Policy loans are not cash value distributions but loans by the insurer, which uses the cash value as collateral. Since no withdrawal is being made from the cash value, no taxes are owed. There are two notable exceptions. If the policy is later surrendered, then unpaid loan balances are paid off using the cash value. At that point there may be an income tax liability to the extent the outstanding loan balance includes gain, i.e., it exceeds the sum of premiums paid. If the policy is a modified endowment contract, MEC, the loan is taxable. Policy surrender. Cash value withdrawals from life insurance are generally treated on a favorable first-in/first out (FIFO) basis for tax purposes, which means withdrawals are treated first as a non-taxable return of premiums. This is true whether the withdrawal is associated with a partial surrender, for example, a cash value withdrawal from a universal life insurance policy, or full policy surrender. Only after the full value of premiums paid to date have been withdrawn are additional withdrawals taxable, as ordinary income. The notable exception to this rule involves modified endowment contracts, MECs, discussed below. Example: Tim owns a universal life policy for which he pays an annual premium of $1,000. He has paid a total of $12,000 in premiums, and the policy has a $20,000 cash value. If Tim makes a $10,000 withdrawal, he will avoid taxation because it is less than the sum of premiums paid. A year later, the sum of premiums paid is $13,000. Were he then to make a $5,000 withdrawal, he would face an income tax liability on $2,000 of that amount. That is because he already used $10,000 of the premiums paid in offsetting the first withdrawal, and only $3,000 remains available to offset the $5,000 second withdrawal. Income taxation of policy dividends. Life insurance policy dividends are a return of excess premiums, called divisible surplus, and therefore are not taxable. However, interest earned on dividends left with the insurer under the accumulated interest dividend option is taxable in the year earned. The dividends themselves, when distributed, are tax-free. Income taxation of accelerated benefits. In accordance with the Health Insurance Portability and Accountability Act, HIPAA, accelerated benefits paid to the insured are not taxable if the insured meets the definition of terminally ill or chronically ill. This applies to distributions from a viatical settlement as well as life insurance policy accelerated benefits provisions. To be classified as terminally ill, the person must be certified by a doctor as having a condition that can be expected to result in death within 24 months. To be classified as chronically ill, the person must have a mental or physical impairment that requires significant medical supervision. Income taxation of endowment contracts. An endowment contract pays a lump sum death benefit at the insured's death but also pays a lump sum benefit if the insured is alive upon reaching a stipulated age, which often was age 65. Endowment contracts purchased after 1986 no longer qualify as life insurance for tax purposes. The cash value does not enjoy tax deferral status. Each year's increase in the cash value is taxable income to the contract owner. Endowment contracts issued before 1986 were grandfathered, meaning they are treated as life insurance for tax purposes, and some continue in force today. Modified endowment contracts, MECs. To receive the favorable tax benefits of life insurance, a policy must meet the tax code's definition of life insurance. Included in this definition is the requirement that the policy not be overfunded so as to generate excessive cash values. A policy that violates this rule is deemed a modified endowment contract, MEC, and loses the benefit of tax-free cash value distributions, whether through loans or withdrawals. When a life insurance policy becomes a MEC, the 7-pay test. A policy becomes a MEC if it fails to meet the 7-pay test, if, at any point during the first 7 policy years, the sum of premiums paid at that point exceeds the sum of premiums that would have been required at that point to pay up the policy in 7 years, the policy becomes a MEC. Once a policy becomes a MEC, it can never revert to a non-MEC status. Income tax treatment of MECs. Policies that are deemed MECs still enjoy 2 important tax advantages that apply to all life insurance policies, but only as long as the policy is used for the fundamental purpose of providing a death benefit. The death benefit is income tax-free when paid at the insured's death. The cash value grows tax-deferred as long as it stays in the contract. However, cash distributions from a MEC while the insured is alive are penalized. Policy dividends, cash value withdrawals, and policy loans are subject to income taxation as follows. MEC withdrawals and policy loans are treated on a last-in/first out, LIFO, basis. That is, they are considered first to be distributions of taxable interest earnings, the last in. Only after all taxable interest has been distributed are any future distributions deemed a non-taxable return of premiums. Dividends received under a MEC, except dividends that are used to purchase paid-up additional insurance, are generally taxable as income. In addition, distributions of earnings from a MEC taken before the owner's age 59 and a half are subject to a 10% premature distribution income tax penalty. The penalty is waived if the policy owner is disabled or if the withdrawal is taken in substantially equal periodic payments over the owner's life expectancy. Key point: do not confuse a MEC with a traditional endowment contract. A MEC is not a unique type of life insurance but a classification assigned to any permanent life insurance policy that violates excessive funding rules of the tax code. Taxation of corporate-owned life insurance. Corporate-owned life insurance, COLI, is any type of individual life insurance covering employees of all levels in which the corporation is both owner and beneficiary. Businesses are permitted to retain the policy even if a covered employee terminates employment. Premiums paid by the business to fund a COLI policy are usually not tax deductible. Written consent of every insured employee is required before the policy is issued, otherwise, death benefits are taxable to the business whenever paid. Obtaining consent after a COLI policy is issued will not reverse this taxable benefit status. For your review. Except in certain transfer for value cases, life insurance death benefits are income tax-free. Settlement options that involve leaving death benefit proceeds with the insurer will result in taxation on the interest portion of future distributions. The death benefit of any life insurance policy owned by the insured at death is included in that person's estate. Policy cash values accumulate tax-deferred and are tax-free if distributed as part of the death benefit. Non-MEC policy cash value distributions are taxed under favorable FIFO rules, meaning withdrawals are treated first as a tax-free return of premiums. Life insurance policy dividends are a return by the insurer of excess premiums, called divisible surplus, and therefore are not taxable, but interest accrued on dividends left with the insurer is taxable. Accelerated benefits paid to the insured are not taxable if certain qualifications are met. A MEC is not a unique type of life insurance but a classification assigned to any permanent life insurance policy that violates excessive funding rules of the tax code. Once a policy becomes a MEC, it can never revert to a non-MEC status. Cash distributions from a MEC while the insured is alive are subject to unfavorable LIFO tax rules and therefore subject to income taxation. If the policy owner is under age 59 and a half, a 10% penalty may also be assessed.
Social benefits of life insurance and annuities are pretty clear to taxing authorities, and so to encourage their use, these products are granted favorable tax treatment. We've talked about some of these favorable treatments in other lessons, but to summarize really quickly, with life insurance, you have the very well-known tax benefit of a tax-free death benefit as well as tax-free accumulation or tax-deferred accumulation. And with annuities, while the distributions are ultimately taxable, the accumulation is also done on a tax-deferred basis. So their use is encouraged by these tax advantages. Now, while life insurance does enjoy favorable tax treatment, the intent is for this product to be used for the purpose of providing a death benefit. We know that life insurance, permanent life insurance, has living benefits, but that's a side benefit of owning the product. This brings up the topic of the modified endowment contract, which is described in this lesson. I just want to take a minute to touch on a couple of points, make sure we understand what a MEC is and maybe what it isn't. First of all, what is a modified endowment contract? A modified endowment contract is any permanent life insurance policy that fails what we call the 7-pay test. Basically says that if the policy is heavily funded in the first 7 years, it's going to become or deemed a modified endowment contract. The lesson talks about what it takes to fail that 7-pay test, but it's important for the exam that you know there is the 7-pay test, and failure to meet that test makes any life insurance policy a modified endowment contract. And that brings up the other point. What is a modified endowment contract not consist of. A modified endowment contract is not a specific type of life insurance policy. Keep that in mind for your licensing exam. A modified endowment contract, as I've already said, is any type of permanent life insurance policy that fails a 7-pay test. Once that happens, it's deemed a modified endowment contract, and once a policy is deemed a MEC, it can never go back. So the bottom line is, you and your customers need to be very, very aware of the 7-pay test when buying a life insurance policy with the intent of funding it very heavily in the early years, because if it's deemed a MEC, you're losing a very important tax benefit.
All right, so let's go over our 4 questions. These could be questions similar to the test. Again, comment below in the comments if you wanted to see these things live in the future. I haven't gotten any comments as of yet, so it won't be happening until I start getting some comments that people are interested in seeing these live. Okay, Cal bought a $100,000 universal life policy. He's paid $8,000 in premiums. He now decides to surrender the policy for the $15,000 cash value. What amount is taxable? It's either 8 or 15. Maybe 15. I don't know. We'll see. I'm going to put 15, but it could be 8. All right. With respect to the transfer for value, or which of the following situations would result in the new owner being subject to tax on the policy's gain upon the insured death? Which of the following situations? Well, we can only hit one, so I don't know why it's saying situations. Business partner or partnership. Policy is sold by the insured to a neighbor in exchange for cash. I'm going to say sold to the business partner. No clue on that one. All right, under the transfer of value rule, which of the following ownership transfers a life insurance policy is a taxable transfer? A sale of the corporation in which the current owner is the officer or shareholder. Sale of the policy to an insured person. Sale of the policy to a business partner or current owner. Which transfer would qualify for taxable? I want to say this one, or it could be this one, partner. All right, we'll see. When received in a lump sum, how are life insurance death benefits commonly taxed to the beneficiary? All right, when received in a lump sum, how are life insurance death benefits commonly taxed? They are generally taxed as income to the beneficiary, but not to the extent of the policy's gain. They are generally tax-free to the beneficiary, but only to the extent of the policy's gain. They're generally fully taxable as income to the beneficiary. I have no idea. All right, we're going to find out together. Let's see what we got. All right, I got none of these correct. So you see how bad I did? This is the first time I got every single one wrong. All right, so the correct answer on this is 7,000. Oh my God, I was way off on that. All right, I don't know how they're getting 7,000. Okay, only the gain, which is the difference between what he paid and the cash value. Okay, so it would be 15 minus 8. That's how they got 7. Okay, is taxable income. All right, let's see how it did. Number 2, policy is sold by the insured to a neighbor in exchange for cash. Okay, that would be subject to tax on the gain. Several types of transfers are not subject to the transfer rule, including policies that are sold to business partners. All right, number 3. Which of the following ownership transfers life insurance policy is a taxable transfer? Sale of the policy to a current owner's brother would be taxable. Who is likely the new beneficiary? If it's sold to someone other than the insurer, like a business partner or a current owner's corporation, the gain on the policy will be taxable to the new owner. All right, so the last one is correct. I didn't get it correct, but the correct answer is they are generally income tax-free to the beneficiary. When received in a lump sum, life insurance death benefits commonly are tax-free to the beneficiary. The question of gain is only concerned in transfer for value situations. Okay, this one's kind of long. It's like 20 minutes long. So I thank everybody who stayed till the end, and I will see you all in the next video.